Good morning. Today is March 2nd, 2024. And today I'm going to talk about something that obviously it's not the first time you've heard us talk about it, but I think it's the first time we'll explain it within this lens. On this platform, obviously, we talk about the digital economy, talk about real estate, but recently I had a conversation with a friend, and he's involved in real estate. So he's actively involved in real estate in Dallas. And I was talking to him about like obviously, we building a real estate portfolio and we're building our digital portfolio. And obviously he's a crypto skeptic. And we got into a conversation. And then I was talking to him about digital economy and becoming a digital landlord or building a digital real estate. And he was very intrigued about what I meant by that. And in the process of conversation, long story short, he convinced me to make a video explaining it within a lens and talking about becoming a digital landlord, or what we refer to as digital real estate, and expanding on that because he felt that that is something that him personally wasn't something that he's benefited from or has heard about blockchain or crypto within that framework. And so today we're going to talk about digital real estate. We'll talk about a few things. I'm not going to go too technical or talk about blockchain or Blockspace. So I'll say I will link, let me go ahead and share my screen. There is a video. There is a link here called Blockspace, an introduction by Chris Dixon. He's a prominent person in the crypto industry. But the point is, this really goes into a lot of details about what we'll talk about today, about like what a block space is, but specifically, for the sake of conversation, the only thing that's pertinent is understanding that a block space is basically the space on the blockchain, which is typically limited to store information or run code. And so, as we're talking about like the digital economy and we're looking at like the proliferation of the digital economy, so like the need for a decentralized way to essentially build consensus, whether that's for transactions, whether that's for executing something. So that's when we talk about smart contracts, whether that's even for something as simple as a decentralized way of having a store value asset, like, when you talk about digital gold or Bitcoin. And so the whole idea is like looking at a look for as more and more as we evolve, as the world evolves, there'll be more and more need for people to have decentralized tools, that is free from the infringement of like, sovereign bodies, like maybe like a government and so on and so forth. But even just looking at even the trends, excuse me, looking at the trends of what we've seen the adoption of blockchain and the adoption of cryptocurrencies go up over the years. And so specifically, that's remarkable because, the big question is, as blockchain proliferates, as the adoption grows, so how can you position yourself to capture network effect from it, and specifically capture value from that? And so that's what brings in the idea of digital real estate. And so for us, that simply is, okay, how can you participate? And there'll be several blockchains. There's several blockchains. Obviously, there's the Bitcoin network, Ethereum, then obviously you talk about layer ones, layer twos, and they talk about monolithic blockchains and modular blockchains, and they're even talking about hybrid blockchains, which combine some of the features of both monolithic and modular blockchains. And so the sake of the conversation here isn't necessarily to get into the weeds, but to understand, simply put, that there is a growing digital economy of participants. So you can see more and more now people are using stuff like stablecoins. For those who are not familiar, stablecoins are basically like cryptocurrencies that are pegged to a fiat currency. So this is like the US dollar. So there's US dollar stablecoins, which we'll talk about, like USDT, USDC. So we're using more stablecoins globally as a way to transact. Even people are opting to use stablecoins, especially for countries, for instance, in my home country, Nigeria, where the currency is devalued significantly over the past couple of years. People are opting to use stablecoins, specifically US dollar stablecoins, instead versus using the local currency, Naira. So, the point is, there are several resources out there that is established. There's a growing digital economy and adoption is growing. So if you look at the adoption curve, I believe last I checked, we're right around 500 million crypto users globally as at the end of 2023, if not higher. So if you believe that there is a growing adoption, so then there's the next obvious question is how to capture value. Again, just summarizing that, that's where digital real estate comes in. And so for us, that looks like, for instance, obviously, I'm going to highlight an example, but specifically that before we get to the example, that looks like basically how can you participate in an economy or a blocks or a network such that you're essentially paid for people using Blockspace on that network. A good example for Bitcoin. Bitcoin utilizes what they call proof of work consensus mechanism, which basically means that you're using something like ASICs or essentially physical devices or hardware rather, to compute the cryptographic equations on the chain, and essentially that's where you get rewarded a block. So like you become essentially a miner. That's where they go into like being a Bitcoin miner. So Bitcoin miners, so like there's in fact Bitcoin mining has exploded because there are even several companies that trade on the US stock market that are Bitcoin miners, like Marathon Digital, for example, Riot, CL, CleanSpark, and so on. So Bitcoin mining it's its own industry. But the point is, so Bitcoin being like the first blockchain, is an example of how you can, if you get the physical hardware, you're able to mine Bitcoin and essentially capture value from people, from the demand of, using block space on Bitcoin. So another example is also proof of stake consensus mechanism, which is where rather than mining, you're staking your ETH. So in this case, which was something that we'll focus on in this discussion today, more proof of stake rather than proof of work. So again, I just want to highlight that there are different kinds. Again, like Bitcoin, proof of work, you mine Bitcoin with physical hardware, which I mean, of course, which goes into like your hash rates and like picking the right hash rate or joining a mining pool and so on. And we've covered some of that on the Patreon. But for a proof of stake consensus mechanism, that requires that you stake essentially the native asset of the network. So for instance, Ethereum, that would be Ether. And you stake the assets. And so after staking the asset, you're able to then validate the network. So you become a validator, right? So it's similar as like, mining, you will also be validating, solving cryptographic equations, and then you're rewarded with rewards for each block. And so, and that reward is essentially your stake. So what you earn is your income. And that reward is also, again, based on the demand for block space on the network. So I like to think about Ethereum block space as a Veblen good. So Veblen good are items that basically, as the demand for the item goes up, the price of the item also goes up as well. So like, is one of the most contested things in crypto, like, the gas fees on Ethereum and so on and so forth. But even when you think about it from capturing value perspective, I mean, regardless of your thoughts, the way the fee system works in Ethereum is that, when you see the surge in fees, it's because there is so much demand for block space on the Ethereum network at that time. Meaning that essentially think about it like going to a bar. I've used this analogy before on social media. It's like going to a bar, but the bartender in this case, let's say the bar or bartender is Ethereum, but rather than having a fixed price for items on the bar, it's based on the highest bidder. So essentially, if me and you walk into a bar and you bid $2 to get an old fashioned, but I come at that very same time and I bid $2.50 or $3 to get an old fashioned, the way the fee system works in Ethereum is that basically the bartender, who essentially in this case would be the validators, would prioritize my order because I'm bidding higher. And so that's why, if you go on your MetaMask or something and they say, hey, here's the recommended fee, or you try to short it, there's a reason why your transaction is very slow, is because you're essentially bidding much less than what essentially other users at that time for the blockchain Ethereum are bidding. And so if you think about it, it's easy to obviously get frustrated, but for us, especially at Easy Finances, when we look at, especially if you think about it from capturing value perspective, that's interesting because it's like, oh wow, okay. So when the fees go higher, it's not necessarily because, of course, the network is congested, and of course there are different things that the network is doing to scale, but it's more so looking at it from like, this is there, rather than getting frustrated at like, oh, it's $100 now to do a transaction. Let's say I'm just using that hypothetically on Ethereum. Is more like, there are people willing to pay $100 at this very moment to do a transaction or transact on the block space. So that for me is the angle we look at it, and gives an idea of the value of this digital economy. Because if you think about it, whether it's to send a transaction, a smart contract, so it's essentially to compute something, store information, it's pretty interesting that like, oh, people are willing to pay sometimes like the gas fees, $50 to transact on Ethereum. And I like to reference Ethereum because maybe Ethereum is the only what I call sustainable layer one blockchain, meaning that when you compare the amount of new token issued versus the amount generated in fees, that means that the amount generated in fees, so that means people transacting on the blockchain based on demand, far exceeds the amounts of essentially new ETH being supplied as reward or rewards to validators. So that's important because that essentially means that there's no token dilution, or there is real yield essentially, meaning that the economic value extracted from fees that the network generates is higher than the amount it dilutes existing either holders or stakers. And so if none of that makes sense, basically that just means it's the only profitable, if you look at true earnings, layer one blockchain. And so prefacing all that to say, so what does the digital landlord or digital real estate comes in? So if you understand blockchain from that lens, Blockspace rather, from that lens, then that means you're understanding that basically there are people who come on chains, on the blockchain, and pay to essentially use Blockspace. So essentially, the way I like to look at it is there are users, tenants, who pay rent for the services, which is Blockspace. Blockchains provide a good or service, and that good or service is Blockspace. So that's ultimately the core of any business model for a blockchain. And so for us, like looking at Ethereum, obviously that's why for us we're largely allocated to Ethereum being the only profitable layer one blockchain at the moment. But then being a digital landlord or digital real estate rather means building a portfolio or a stake. Because remember, we referenced staking because Ethereum is proof of stake consensus. So building a portfolio or stake, whereas your stake, which is like your principal, your asset, is generating you rewards, which is, remember, as a validator, when you stake your ETH and you're validating the network, you're rewarded in terms of just like how miners are rewarded Bitcoin for mining block rewards, you're also rewarded ETH for staking. And so that's the in-kind asset. So and obviously, being long-term bullish on Ethereum, the digital economy, the growing adoption, you can think about it from the lens of you can build a portfolio on the blockchain, which is your stake, that is generating you rewards, and then which is essentially income. And so when you look at it from that lens, you're a landlord whose asset or real estate is your stake, whose your tenants are the users who are using the Ethereum blockchain and paying the Ethereum blockchain money to use it, to transact on it, to store information, whatever it may be, execute smart contracts. And in this case, I like to also say it's not necessarily physical users too. And that's the unique thing about Ethereum's modular design. Other blockchains could also pay Ethereum to store information. So that's called the concept of being a data availability layer. So a DA layer, or in every form. So that's why I'd say, like, if you look at going to Ethereum, the percentage of use or block space by layer twos. Layer twos are, again, not for the sake of this call, but essentially think about it as Ethereum is a layer one blockchain, like the foundation, and layer twos are other blockchains that are built on top of Ethereum. And so layer twos are obviously cheaper, better for retail. So people talk about, cheaper transaction, which is critical for retail users. That's when we talk about layer twos. So as the percentage of block space consumed by layer twos continues to increase. So that's an example of how even when it comes to renting block space on Ethereum, doesn't necessarily have to be individual users. It could also be other blockchains. So layer twos, for example. And so, yeah, so that's the concept of digital real estate, is like basically you're building a stake, you're building your portfolio on top of the blockchain, right? And then that portfolio generates you income, and that income is like rent checks. So you're collecting rent on the blockchain, and the renters are the users, or other blockchains that are essentially paying Ethereum to use this block space. And just to highlight this concept, I'm just gonna I don't want this to be a long-winded video. I'm trying to do better to, do short videos as well, because I feel like obviously some people like the short form content. But, just highlighting that, just a quick example. And, this is not the first time we've shown our instadapp lite portfolio, but as an example of, for instance, obviously it's grown since then. Ethereum has been on a ripper since we last talked about this, I believe May of last year. But so this is an example of our portfolio. We took out some ETH that we've earned in reward in the past year, about 2 ETH worth or so, to go purchase another asset. But this is basically our stake, and it generates basically in the past year about 2.5 ETH is generated. In the past month, it was about 0.22 ETH. And so in the past month, at current ETH price, I'm checking my phone right now to see. So it was about 0.22 ETH, and current ETH price as of recording this video, it's about 34.10. So 0.22 ETH times 34.10. So that's about $750. So you can think about it. So I'm just gonna refresh it because they don't say like, oh, you didn't refresh it. Is this live? Yeah. So refresh it. This is instadapp lite. So you think about it. This is basically an asset. So a real estate on the blockchain. So on the blockchain that in the past month at current Ethereum price of 34.10 has generated us basically $750 in the past month for February of 2024. And so if you think about it, our initial capital year was actually, and I really like this too, because it's a very powerful passive income tool in our opinion. Obviously, our on-chain asset managers here, instadapp, there's several ways to stake your ETH. I want to clarify that. You can be a solo staker, so you can do it by yourself at home, run your own validator. You can stake with a centralized exchange like Coinbase. You can also stake on-chain with platforms like instadapp. I've been using instadapp as a crypto user since 2021, done collateralization with them. It's one of the teams I prefer, but please do whatever you prefer. This is not financial advice. Do whatever fits, your strategy. This fits ours, and just documenting that and saying that for record purposes. That said, yeah, so this is it. So we put $58,000 into this in February of 2023. So it's been a little over a year now. Once again, like I mentioned, so February 20th, 2023 to be exact. And so, yeah, so if you look at it, this past month, $750. So assuming even, of course, we're expecting the pivot, we're expecting halving as well shortly here. So we're expecting some and of course, God willing, if the spot ETS for Ether also launches this year, there's several bullish catalysts that we expect the underlying price in USD to go up. But assuming that even we stay at the current price of 34.10, we think about it, annualized, that's $750 times 12, which is about, if you look at this, that's about like almost $9,000. And again, it was a bit higher in 2024, because one thing I should also mention is, like, remember what I said, it's all based on demand for Ethereum block space. So as we've recovered from the bear market, we've seen activity on chain pick up in 2024. So that's why in the past month, we've earned a bit higher than our typical monthly average, about 0.2. And the past month, we earned 0.22. So that's another thing too. That's why I mentioned about being literally a digital landlord, because one thing with this vault, basically, as we just implied, is as network activity goes up, so does the APY. So again, this is all based on the rewards you collect staking on or validating the Ethereum network. So as you can imagine, network activity goes, the APY here is basically based on on-chain activity. And there's other factors too, like number of stakers, but in general, not to not get too technical, is based on the network activity. So again, because network activity has picked up in 2024, we are earning more ETH monthly than our monthly average, which is around 0.2, which would be, if it was 0.2, rather, that's 0.2 times 34.10. So that's about $682, right? At today's price, at current price. But in this case, because we've earned 0.22 in the past month of February 2024, it was once again $750, right? So again, all that to say, this is an example. So going back to what we said, 58,000 was our initial investment, $750, which is what we earned in February 2024. If we analyze that, that's 750 times 12, about $9,000 divided by $58,000. That's about 15.5% cash on cash returns, what we're projected at minimum to earn. Because you have to think about it, we're earning in terms of ETH, right? We're on chain, we're earning in terms of ETH. So as we expect, if the price does go up, which again, we're not magicians or we don't know the future, right? So we're speculating here, but if price does go up, right, which we anticipate, so does the amount you earn monthly. So for instance, even if I earn, let's say the exact same 0.22 ETH for the month of March, but let's say price goes up to 4,000, all of a sudden that's now $880 versus 750. So that's the concept of, like, again, like I said, you're essentially building assets on chain, and you're using those assets to build you income on chain, and you're becoming, for lack of better words, essentially a digital landlord. And that is the concept of digital real estate, and leveraging digital real estate to build on-chain income and becoming a digital landlord. So again, I wanted to keep this brief. Hopefully that makes sense. My friend did, again, my friend in Dallas did convince me that I need to put this out there and explain it within that concept. And honestly, truly, that's how we view it when we talk about building our real world real estate portfolio. So especially here in the Southeast, which we talked about, is our focus. And of course, building our on-chain or digital real estate portfolio, which is building income on chain. With that said, signing out. Peace.